Charlie Gao, welcome to the Best Ever CRE show. How are you doing today?
I'm doing all right. Thanks for having me.
Hey, we're looking forward to the conversation. I know you've been on before, so you're brave enough to come back. We didn't scare you off. That's always a good thing. Will you give the Best Ever listeners a bit of a reminder on your background and what you focus on?
So last time I was on the podcast, I think I was focusing primarily on small multifamily and multifamily. I have a background in the trades. Long story short, my dad was in real estate. He came to the United States as a master electrician, didn't know how to speak English, and we grew up in an era that was primarily 97% white Caucasian. And he found a woman that happened to speak Chinese, and essentially he made himself so irreplaceable to her over the course of 20 years that she sold off her entire real estate portfolio. And so where I fit into that was my dad looked at me as free labor, filling up dumpsters, lifting toilets, anything you could think of, every child labor law you could think of that could possibly be broken. I pretty much broke as a teenager and child growing up. And so I spent about a decade outside of real estate altogether because I was like, real estate sucks. I don't want to do what my dad does. And then I quickly realized, if I'm working this hard for somebody else, especially a Fortune 500 company, and I'm making six figures, I probably could do a lot better for myself. So then I got into real estate, and then flash forward today, I would consider myself most well-known for self-storage. If you were to Google my name, I have quite a few videos of content about self-storage, and I speak at the Worldwide Expo. But we've built and developed over 3 million square feet in the self-storage industry. Overall, though, my portfolio is pretty diverse, though, both in industrial, office, still have some multifamily, and then retail as well.
Charlie, what year did you get into self-storage?
I got into self-storage. Well, it's hard to say when I really got into it because I got into it first when my dad was exposed to it. We owned an apartment complex across the street from a self-storage facility, and they contacted my dad's accountant, who was the owner on record of the LLC, and said, "Hey, do you want to buy the self-storage facility across the street?" So that was 30 years ago that we got into that. And then we sold it, at the time, I think for like $45 a square foot, which we thought like, okay, it's never going to get higher than this, right? And then I got back into around 2011 where I was looking into it pretty heavily. I was thinking about making the transition to multifamily. I was doing a lot of multifamily brokerage, and I found that I was actually competing with some of my clients on the multifamily side. And so that's when I decided, you know what, let me just focus on multifamily brokerage now, and let's transition into a new asset class that I've always wanted to get back into.
Good for you for taking the high road, not competing with your clients, where a lot of brokers will keep the good deals for themselves and give the rest away.
Yeah, I mean, there's definitely a conflict of interest, but, during that 2008 to 2011 run, and then there was also a run, obviously, here, coming in and out of COVID, where there was a large influx of money into the economy. We just found that, like, for example, I had a 48-year under contract for $2.8 million. I had a client that just sold $1.5 million of real estate for, and they came back to me and said, "Hey, I need something to buy. I can 1031 into this." And so, I was like, well, I have this deal that I was thinking about buying myself. And so sometimes those deals, they're just straight brokerage, it's straight commission. A lot of times what I try to turn it into is I try to turn it into an equity situation where I can forego my commission and have equity. And then the nice thing about it too, as well, is that then I have more partners to look to partner or raise funds with down the road. So in that particular deal, for example, I actually, instead of taking, 2 or 3 or 4% commission, I took a 10% equity share into it with no money down, essentially.
Charlie, how have you seen self-storage evolve over the years?
This is the most common question I get by far, and people are always surprised to hear my answer, but because I'm so exposed to it. But I don't see a ton of positives on a national level with self-storage. I've actually invested in other self-storage concepts as well. So, for example, you can now use an iPhone or Droid app to schedule a storage unit or trailer to essentially be delivered to your home. You can rent it by the day, the week, or the month basis, and then have them basically deliver it back. You have storage pods where people can store it on site. You also have now a storage condominiums, which we have exposure to as well. And so you're seeing the market for general storage contract. And then also now you also have Menards now doing contractor suites then too as well, where they're offering additional services. And so the days where we used to see like, hey, I'm going to pop up a cheap self-storage, cold storage, very little service, only pick up the phone, when you have units available. I think those days are going away. Self-storage is fundable through SBA financing, which is really treats it as a business, not real estate. And I think going forward, you're going to see that you're really going to have to run a business, not real estate with some type of passive operation going forward. Now, that doesn't mean that I don't see opportunities on a local level, but it's really just like any other asset class I invest in. I really want to look at everything as a whole.
Charlie, it's really interesting you just brought up these sort of newer technologies that are options and alternatives to traditional self-storage. With you having significant exposure in self-storage right now, how is that informing what your plans are with your current self-storage assets?
Yeah, so back to offering services that distinguish us from others, whether that is, offering boxes, offering delivery. For example, I used to work in the pharmaceutical sales industry. And one of the things that I used to do is I used to always go to storage facilities where they offered free transfer of my samples. So if I had pharmaceutical samples shipped, I would actually have them take that shipment and actually put that in my unit. Whereas a lot of places are like, no, you got to transition to that, where it's like, well, I can't leave items that are medical, in with a bunch of other things. Car wash, waxing, vinyl wrapping, units with power. So if you have a boat and you want to have a bait fridge or somewhere to store your beer so you can just go straight out in the lake, all those additional services we're trying to go. So rather than comparing us to what everybody else is doing, we're trying to find inroads to what is everybody not offering that we can offer and be the only one, so we have no competition.
Sounds like a hybrid of flex space.
Yeah, pretty close. Because you look at, one of the things that has hurt us, I think, more recently over the years is that some of my long-term tenants that would have, 300 square feet or more, and they see that they're paying, anywhere from $250 to $450, $1 square foot rent, which multifamily might not even be getting $1 square foot rent. And they see that, they're like, I might as well buy a condo then. And then that way, then at least it's something I own. Now, whether that's really true or not, I'm not going to go into that because that's a whole nother debate. But, now we're seeing a lot more transient. I'm not seeing as many people stay for 2, 3, or 4 years because, once they've paid me $3,000, $4,000, $5,000, $6,000 and they see those numbers going out, a lot of times they look for other alternatives where now I have something potentially to save if I've spent $18,000, $20,000 in rent at your facility over the years.
It's really interesting you said delivery too. I am not a self-storage user, but if I were a self-storage user, somebody coming and picking it up for me and delivering it for me would be by far preferred over me having to go get it. What is involved in transitioning to that sort of business? You don't just have a pod, right? You have the physical boxes, they can't be moved. So how does it actually work?
Yeah, it'd be very similar to like a U-Haul trailer. So so you have the pod, which the pod is really ideal for so for example, we were renovating a basement and we had a bunch of stuff in the basement and we didn't want to store it in the house. So we had them deliver a pod and then send it out. But if I'm doing a very large renovation where maybe I don't have the access to store it, then this model is the next one and you can rent it by the day, the week, or the month. In the self-storage side, we typically don't like those kind of customers because, after I pay a commission to somebody to move them in and they only want to move in for 5 or 6 days, it's not really a good pivot on the business model. So we don't prorate. So it may actually be going after customers that we may not necessarily need, but it offers a very specific niche that can be addressed for people who, I don't need to store for more than a month. I may, but I like the flexibility now. I don't have to go rent a U-Haul truck, take it to my storage facility when I'm done and I need it, and I need to get another U-Haul and bring it back. You really have all in one. Now, the downside about that, though, is that trailer as it's being moved, you might have things that are fragile, so you need to make sure that you store it in a way that it can't be broken when it's moved, because it's not a static storage. But ultimately, that serves a demographic that historically storage has always served.
Charlie, that's very interesting. The first thing that came to my mind was liability when you were talking about moving other people's stuff. Is there a certain storage owner that it makes sense to do this delivery model? I assume there's some amount of scale that makes sense. You have to have insurance. Who does it make sense for, and what type of storage assets does it not make sense for?
I mean, the bigger thing is if you have the driver, that's one thing. So, I find that excavating companies that basically are doing large transport already, it makes sense for them. It could be somebody that, I find that a lot of tradespeople often do well with self-storage. So we do a lot of consulting, and I find that a lot of times my clients that kind of gravitate towards me are typically electrician, concrete guys and things like that. So I think those scenarios are generally the ones that work the best when they already understand it versus trying to build out that process. That doesn't mean that you can't, but if you're already kind of understand like, hey, I'm already moving dumpsters, or I'm already doing flatbed truck with large transport, those kind of things are very easy. And then also now you can leverage it amongst multiple businesses, because you might have a truck that you're using for your business for something else, and now you can pivot off of that. And so I find in the Midwest, we also see a lot of times where you'll see like a landscaping company or a concrete company that has 2 or 3 extra acres of land, and they build a self-storage facility right next to it too. So those are where I see from a mom and pop level, where national level is a little bit different. You're actually building that out from scratch.
Charlie, did I hear you say that you had a self-storage facility that took your shipments and put them into your locker, your box?
Yeah. And I mean, then that service is definitely additional cost. And sometimes also the handling of it requires certifications too as well, which it's a pain to get those, but generally they're very easy to get. And then once you get them, now you're distinguishing yourself for wait. So I'm the only one that can move medical supplies for you, take delivery, sign for it, and put in your unit. Well, now it doesn't even matter. And plus the best thing about it too as well is that, not to see how irresponsible with spending my Fortune 500 company's job, but if it was 20% more to drive another mile versus one right next to my house, generally I was spending the company money on the extra 20%. And so when you have a corporation that's paying on behalf of someone that's making that decision, it's pretty easy. Because ultimately, I'm sure that the company I worked for at that time wasn't worried about me saving $15 or $20. They were wanting me out there to make them, millions of dollars. But that is a really, really good way to distinguish yourself from others.
Charlie, delivery and acceptance of medical supplies seems like a super niche product. How scalable is this sort of delivery concept to help save self-storage?
Well, I mean, you look at the medical industry. Don't quote me on this, but I think it's double-digit percentage of our GDP when you look at our healthcare industry as a whole. But like, just from my personal level, like the company I worked for, well, actually, I'll start with the very first company. The very first pharmaceutical company I worked for was a top 50 company. And just at the one facility that we all use, there was 30 reps at. So I don't have a lot of data to kind of look into that. But basically everybody within the company was like, hey, who are you using? And so just within my 30 square mile radius, there's 30 reps at one single company that was able to all just go to this company because it was really the only one around that accepted and delivered to their unit.
All right. So that's kind of one way to add income and revenue to self-storage these days. What are you doing? Are you pivoting assets, or are you just doubling down and finding other income streams for self-storage?
So so Twin Oaks Capital, our firm, we really look at 3 different things that add to our secret sauce. So one, basically, we are very hyper specific to the territory or area. So primarily that's West Michigan and Central Florida. I know those areas very well. I'm dealing with the same municipalities over and over again. I don't have to look stuff up because I already know it. So that's number one. Number 2, we basically are vertically integrated. So property management, asset management. The majority of that outside of multifamily, that's all in-house, so we get the operations done. And then the third deal is that we do use brokers as well, but we also source the majority of our deals in-house, either through off-market through brokers or also through basically finding them myself. So as long as it meets at least 2 of those 3 criteria, then we're good to go. So that doesn't have to be self-storage. I have an unfair advantage simply because I know it, the asset class as well as anybody else. But if I find, for example, I have an industrial building. A client of mine came to me and it was asking me for just advice on about leasing. Had nothing to do with that, but then he told me what he was paying for rent. He told me the owner was actually willing to sell it to him at this price. And then I looked at the numbers and I'm like, wow, that's really, really low for the market. And so flash forward, 8 months later after that, I own 84,000 square feet of industrial. So if the opportunity presents itself and it's an area that I can leverage my unfair advantages, I have no problem transitioning to a new asset class.
Did you steal that deal from your buddy?
That's what I was thinking.
So like all our other deals, we offered him two scenarios. One, you can basically buy in as an equity owner, or if you don't want to, be exposed to real estate because they got bad advice from somebody that says real estate is risky. So we gave them a below market rate. So they're 20% below market for the next 5 years. And pretty much we're doing so well on that I could even extend it beyond that 5 years. But that's what we agreed to. I don't mind over delivering on that because I've gotten more than what I expected. But that's the nice thing about, doing those type of deals. He knew about this deal that I do those type of deals because I talked about on podcasts like this actually, but he wasn't even reaching out to me. He just wanted to see what I thought about his lease, and then buying was the last thing on his mind. So we put that in his head. We offered him the options. We was fully disclosed about that. He was happy about it. So ultimately it was a win-win for everybody involved.
Good. Charlie, I want to circle back to the handling of packages and putting them in your storage unit. Now, I get the medical device case study, and then I would imagine if you live in the hood, you want your packages maybe to go to a storage facility so they don't get jacked. What other use cases are there where people won't accept delivery at their home or business, but they would rather have it into a storage unit?
Yeah, I mean, well, now when you frame it that way, you also are competing with kind of the UPS stores and those kind of stores too as well. So the bigger difference though is that why it works out so well is because if you don't want to take that home, like you want to have it stored someplace, it makes sense to just send it right to where you're storing. So that would be the differentiation between somebody that just wants to make sure that, hey, I don't want to get stolen while it's sitting on my porch versus, okay, I also don't want to have to pick it up too as well. But in those scenarios where, like, for example, my one facility, it's 120,000 square feet. We have a full-time property manager that is there to handle everything. So to add something small on like that, and that also creates an additional source of revenue for that person. Those are really, really easy for them to do. Like, okay, hey, I upsold, so we offer upsell bonuses. So other companies do not do this, but if you work for my company and you work in our sales department, essentially with taking calls, you can get paid on setting the person up with tenant protection. You can get paid on setting them up with actual the storage unit, and then also additional services. If you upsell them wrapping and winterizing their boat, if you upsell them electrical outlet, if you upsell them the storage, all those things are things that we have actively engaged because our staff is aligned with when we make money. And so in those cases, it's honestly not really hard because we actually have people honestly selling it, and it's very, very distinct on what their need is. If that person has a need for it, they'll say yes. If you don't, we don't have to sell it hard. So there's really not a lot of selling off. It's really just simply bringing it up to the customer that we have the service. Because the one thing we run into the most was when we offer all these services that others don't offer is people don't even know how to ask for it. So if they don't even ask for it, then there's no way for us to sell it. So we try to have incremental conversations between, here and there. So for example, if somebody tells us that they're in the medical business, then that will be something that would immediately think, okay, we can do that. Or if somebody asks us specifically about where our items are stored when a delivery gets taken, if they specifically ask it, then we know that's immediate upsell because obviously they're concerned. They don't want to have their boxes stored in with 30 other people in a room that's locked. But yeah, it wouldn't be hard for me to go in there and grab somebody else's, like, oh, Gucci bag. Let me say this is mine too as well, right? So in a lot of ways, even though you could say it's adding more risk on delivery, I would actually argue that you have just as much risk by having everything that gets delivered stored in one room for who knows how long before they come and pick it up and move into their unit.
You are the only person I've ever spoken with that's innovating in the self-storage industry. Good for you.
Thank you.
Everyone else that we've spoken with, well, you know what's interesting? Right now, there's these big syndicators out there that are still raising money for self-storage, but your first answer to our question was nationwide, there's a lot of challenges to self-storage. So I'm assuming you mean they were overbuilt, prices are coming down on the cost of running a storage unit because of competition. Is there a lack of demand as well?
So we do feasibility studies in-house. And so like I'll use an example of one we had, but the exact same site that's super ideal for storage. I've actually done 5 feasibility studies on the exact same site. And that was over the course of 3 years. And I can tell you it got significantly worse. What I am seeing, and this is perfectly allowed within the industry, is that people are building out the need for future demand today. So for example, I'll use Austin, Texas. There's double-digit population growth. And so what we would do for our feasibility studies is that if you were building in 2025, but you might be finished in 2026 and your lease up wouldn't be completed until 2027 or 28, we were actually using the forward population 3 years from now by saying, okay, the population is going to grow by 300,000 people. So based on that future population, this shows that you have enough demand for that. But granted, that's still on projection, right? That's perfectly allowed within the industry, but you were seeing a lot of people do that. And so like, for example, like Denver, Colorado, a few years back, they actually had almost 40% of all their square footage that was to be delivered. So there might be 300,000 square feet in the area, but there was going to be another 40% that was going to be coming to the market. So we saw a lot of that. Also, now you have higher holding costs too as well. So the days of me getting 3.5% on construction, those are gone. Maybe around 6%, 6.5% on construction. So if I'm doing a $10 million deal, now I have thousands of dollars of more hold cost too as well. So all those things are making it tighter. And then the last thing is also you have competition from all these things that we have not quantified how much that contributes to the lack of demand now, because historically feasibility studies have always been based on population. That's it. Square foot per capita, 8 square foot per capita, whatever. So
building for tomorrow or 3 years down the road is the same stupidity that got multifamily overbuilt. Places like Denver, Austin, Atlanta. How stupid is that? How does that make any sense?
Yeah.
Who does that? What other asset class does that besides multifamily and self-storage? Self-storage historically has been fueled by, we hear the 3 Ds, death, divorce, and downsizing. I went down a rabbit hole and I thought I debunked this. So death, when you had, what do they call it? The greatest generation, when they passed, the baby boomers took in all their belongings. They grew up in the Depression era. We didn't get rid of things. We didn't have estate sales. We put them in self-storage, or at least baby boomers did. Well, Gen X and certainly millennials, they do not want their parents' belongings. So when parents pass, there's those estate sales and everything but the house type sale. Divorce. So divorce rate used to be over 50% for first marriages, 60% for second marriages. Millennials now are getting married much later, and they're getting divorced at a rate far significantly below their predecessors. So I think we debunked divorce. Downsizing. I think Gen X was the last generation to upsize. Millennials have always lived in boxes or apartments or smaller rentals. So what's fueling demand for self-storage?
What you just said, the rationale is sound, but the data does not prove it. Every year we have more square foot per capita, and we do still have actually increased demand. Part of that's because of awareness. There was a lot of stigmas against self-storage, 10, 15, 20 years ago. I think the classic image people would think of self-storage is like, somebody living out of the unit and changing and trying to interview for a job, right? I mean, like there was not a lot of great images of people who had self-storage units. The biggest thing that I see as a driver is that people are consuming more than they ever had before. And also the cost of the goods of which they store is also increasing, which makes sense for the return on costs. So this data is very, very old, but I've been quoting it for a decade, but I don't know what it is now. But for the longest time, the metric was if you had a storage unit with us, you stored roughly 9 times its value, its monthly value. So what that means is that if you're paying $100 to us, you were storing $900 of merchandise with us, which means also, like you're probably already thinking, after 9 months, you'd be better off just selling the stuff versus doing that.
That is,
100%.
Just buy all new shit in 9 months.
Yeah, exactly. And you see it happen all the time. But now you have, the average car in the United States now, I think just eclipsed $50,000. So when you have things that cost more and the cost of your storage unit is not rising with the cost of goods, it does make sense now to store those items. So if I was thinking about storing a $20,000 car and a $200 unit a decade ago, but that same unit might be $400, but that same car's $50,000. It makes sense now based on what you're storing to store it. So that's another way to look at that. And then the other thing about it too as well, this is a metric that's secondary. I've heard other people start to use it too as well. I want to say I'm the first, but it's not widely accepted yet. But I also track it with rates of other commercial real estate, like industrial and like multifamily. Because as the old adage says, is that everybody has to have a place to store, but they don't have to store the items if they don't need it on a daily basis. Now, I'll use the example, but like, let's say I have an 800 square foot apartment and I'm paying 80 cents let's say I'm paying $1 a square foot. And I'm thinking about upgrading to a 1,000 square foot apartment because I need space for storage, right? Well, if I look at a storage unit and I can get a storage unit for $1.20 a square foot, then it just makes sense for me to upgrade to a 1,000 square foot unit, right? On the flip side of that, if I can get a storage unit for 30 cents a square foot, maybe it makes sense for me to stay in my 800 square foot apartment and then pay a lower rate on what it costs to store. That's another metric I track for what is going to be the demand for storage, because if people have needs to store much cheaper with other asset classes, that would definitely influence the market.
Charlie, you just listed off like 100 different metrics that sound super technical and I'm sure are super informative in one of your feasibility studies that you're doing for a lot of other potential builders. Are you yourself still developing self-storage?
At this point in time, the holy grail of what I would like to buy versus what banks are lending on, and keyword lending on, is if I can find a facility that, somewhere between 20 and 30,000 square feet, enough for me to manage in-house, while adding additional square footage, because I can still most of the time build at, a $10 to $25 a square foot delta, meaning I could build at $50 a square foot, but the market is worth 65 as the second I built it. That's ideally what I'm looking for. Right now, the majority of my time has been spent on making each of our facilities that much more efficient, whether that is adding more facilities for management and bringing down our per facility cost down, or adding other sources of revenue to as well to make them more valuable for a potential exit down the road.
And you are doing a lot of those really cool things, like all these different upsells and delivery and all of that. How does the revenue and the income from those incremental services factor into valuation compared to just the raw rents? Are they different for an evaluation perspective?
You already pointed out I dig in the weeds too much. So I'm going to try and make this answer as simple as possible. When I evaluate value-add services, I try not to value them too much based on the form of income they add. Obviously, they have to make money on my initial projections. I actually try to focus more on the stickiness of the product to keep our customers there for a long time. I personally don't like to turn over tenants, every 9 months. So I try to find services that are going to make this customer going to be there 2, 3, or 4 years that will make them loyal to only our facility because only we're the ones that offer it. So it's more of a value add on the back end. I don't have to keep having turnover over and over again because there's cost of turnover. That's what we're really focused on, more of these services. But then on the back end, what we often discover is that they also are on a standalone, they make very good money on their own.
Yeah, I can't get over how simple of an idea, but how innovative to the point where no one else is doing that. The fact that if you have a boat, you can say, hey, on this date, we're going to have people wrapping boats to put in storage, or every Tuesday, you can have your car detailed. Brilliant moves. But, Charlie, we've interviewed some people that are in self-storage, and what we heard was that the customers that are currently paying to rent units, those are going to be your highest paying customers. Beyond that, you have to offer X number of weeks or months free rent and all these specials to where they're going to be lower than existing customers. Are you finding that as well?
Yes. I mean, part of it is obviously depending on, your staff that sells it. And also, if you offer those services that nobody else offers, then there's no price point for somebody to compare it to. So one of my units, storage facilities, my manager is actually the previous owner. So we give him incentive to get Google 5-star reviews, and he gets about 50 of them a year. But I can tell you that he sells it better than anybody else. It's something that we can't even quantify. But for example, like our facility we actually have a loader where we take the snow and we don't just plow it where you're blocked up, a foot of snow up against your unit and then you can't access it or there freezes. We literally move the snow over to another side of the facility where it's blocked off so the snow can't even blow back against it. Because that's the other thing that you run into in some areas of the Midwest is that, cool, I put a 5-foot, mound of snow 10 feet away from the unit, and then a day later, the wind blows it all up against it, right? But he has such high conviction for, you're going to love storing with us. Yeah, we're 20% more than everybody else, but our place is the cleanest, driest, and I personally clean out every single unit. And so it's weird that a lot of people think he's the owner still. I don't care that people think he's the owner. So yes, what they said or they're saying, it is true. But when you try to battle these REITs, these companies that do something very, very well that I don't have a competitive advantage for, even though we're starting to get some of those, obviously, as we add scale, we try to basically not fight them out over those things and try to go after the niches because, that's where the riches are, right? The niches are riches are niches, and we don't have to compete with anybody. We don't have to compete with somebody comparing us either. So that's kind of the shortest answer possible is just don't compete with them because you offer something completely different than what they offer.
Yeah, great philosophy. Charlie, is your pricing variable?
You mean demand-based?
No, like let's say somebody like Amanda, dressed nice, walks in. Do you charge her more versus, a schlup like me walks in, probably not dressed very nice, and you probably can't think I can afford a whole lot? Do you base pricing?
Yeah,
on what you can get?
nobody is going to admit to that, even if they did do it. We certainly don't do that. I don't know anybody in my sphere of influence that does that, but we definitely do demand-based pricing based on the units and availability and the market. So we utilize, just like everybody else, utilize AI to analyze what our competitors are charging. And then we build out. So if I have a mom and pop down the road, I'm not trying to be only 5% more than them when I offer way better service. I'm trying to be 30%. So then we cost adjust it based on what we can think we can charge in relationship to that. And then also then the last thing is the availability. So if I only have one 10 by 10 left, there's no way that I'm not raising it. So once we get to, anywhere between, 90 to 95% occupancy, we're incrementally increasing the rates, at least for the people that are coming in brand new. And then also, if somebody else says, well, hey, my friend got that, I'm like, well, that's our way of rewarding them for storing with us for a year or 2 or 3 years or 4 years. Now, one of the big things I think with revenue management is that the gurus say to raise rents in February. It's the worst time of year. Nobody wants to move in the winter. We are not quite on that model. We try to go a little bit off of that, but we're really more proactive on the revenue management on new customers coming in, and then also maintaining that if somebody's with us, that we will raise rents on them, but we maintain their loyalty by keeping them slightly below market, or at least our new market, that is.
Yeah, we interviewed a guy who would get on Google Maps, look at the address of where each of his customers lived, and based on what he thought they could afford, he would raise their rent. So again, if there's a guy or girl living in a mansion, they know they can continue to raise rents. Somebody living in an apartment, they probably stable off their rent at some point. You guys do that?
We try to use actual data. So why I agree with that. So for example, let's say that I have a boat storage lot where I have an empty lot that I want to do boat storage for, and there's literally no comps around. Sometimes people come to us and say, hey, can you do a feasibility study? I'm like, you could do a feasibility study, but we do a feasibility study. It's going to cost you $3,500, $4,000. What I would suggest doing, and this is what we personally do, is put a website up, make a wait list, and offer them a bonus to sign up for that wait list. And if you spend $4,000 on SEO on a website, and then you actually build, now you actually have something to translate. And so in that instance, because we had a deal like this many years ago where the bank's like, I don't really like this feasibility study. There wasn't any data for them to interpret. Then we went back and it's like, well, why can you get $1.60 a square foot? I'm like, well, I got a wait list of 45 people that says they will pay $1.60 a square foot. Money talks, right? So I prefer to go after actual data. So if I show data that from my facility that we are continually able to raise rates, then we will raise rates based on the lease up data on how fast. I try not to base that income too much, and that could be skewed because, for example, I could be on one school district but only a quarter mile from another school district. But if I use a 5 mile square radius, I'm getting income from a potentially poorer side of town mixed in with the nicer side of town, right? So that is a metric we would definitely consider, but the overall data that we want to look at is what is actually in front of us. What is the actual indicator, not a leading indicator of what could potentially come.
Hey, Charlie, remember you said you did the same feasibility study 5 times on the same lot?
Yeah.
Did you charge the same amount each of those 5 times in 2 years?
Yeah, it was very lucrative for us from a certain standpoint. Now, actually, I will say this from an exception. The first one we charged a lot, and then there was another one within like 6 months of that, and I was basically like, so we have three levels of feasibility study. There's one is this is our most popular one by far. It's roughly $1,500, but it's basically a report pull, where if you were to pull the report, it would cost you a decent amount of money. If I pull it, because it's basically non-existent cost for me because I pull so many. But what people really want is hey, what does Charlie think about this? So it's like, there's no written report. It's just, hey, this is the data. This is how you interpret it. And then you can go to your full scale, that's where like you got out-of-state investors, maybe out-of-state bank. They want to see all this fluff data that you probably already know as the operator. So in that case, what we did is that when there was a close follow-up within 6 months, I would say, I already did this, so I can just do this $1,500 micro report, because I just need to update what the data shows on today. But most of the other information is still going to be relevant. Now, we push it out 2 years later, then I pretty much do need to do a full scale look, because the data is too old at that point in time.
All right. So you didn't pull one over on them.
Yeah, I didn't do like full $4,000 when, and because in most cases, most of our clients do repeat studies with us because, for example, they're doing expansions or whatnot. And so a lot of times, when I reach out to them, they reach out because they know I'll say it. Because there's no point in, not everybody feels this way. I'm not going to try to call anybody out. But when somebody pays us $4,000, my staff pulls a report, and it's like, it's oversupplied by like double. Do we really want to give them all this fluff information about why this facility sucks? So then what we do is we call them back, and it's like, hey, the data is not going to be good, at least from my perspective on how I'm going to do it. You might have some confounding variables that might show otherwise, and that might be true. But for what I have to send you to show to a bank, it's not going to help you. Do you still want me to spend an extra $4,000, or I can just credit you back $2,500? So that's one of the things that we do. If it looks that bad, there's no reason for us to do that, because there's nothing that has ever made me more mad than paying $4,000 for a feasibility study, only to be literally just like piling on why the location's not good, which that hasn't happened in a long time, obviously, because now I know how to do feasibility study, but it definitely happened in the beginning.
Good for you, Charlie, for being honest about that and calling people back. Right now, with the outlook of self-storage, like you've said, are you doing a lot of feasibility studies, and who are these builders right now?
We are not doing a ton of feasibility studies. One of the main reasons I started doing feasibility studies is because for our own personal growth, it showed, hey, this is credible to do that, because, for example, I use a very national base. Everybody knows him for a feasibility study. And they're like, hey, have you done any pre-work? I'm like, oh yeah. So we gave them our feasibility study, and they literally like basically copied all the information, give it back to us. And then we got our bill. And then I went back to the bank, and I'm like, do I really have to pay for these? And they're like, no, you don't have to do them. We know you know how to do them. So the main reason I added was more of a value add for the visibility of our business, because at one point we were going out of state. We were targeting a deal in Hawaii, for example. And so when we were targeting these other markets, when we were hyper local to our market, it was easy for the banks to overlook some things. But then now they want, okay, I want more metrics, because we know you're not as familiar with this area as your other ones. So that was kind of the main reason I asked it. Overall, I'd say we do about 20 to 40 a year, not a ton. It's not really a super lucrative. And the other thing about it too, as well, is that my staff, when they sell them for me, they get a nice bonus on it too, as well. So that's another reason I like to do it, because if you know how I operate my company, everybody is incentivized to make money when we make money. And so I always try to find ways so I can make my staff money, because the last thing I want to have, and I've had this happen multiple times, is somebody coming after my staff and offer them $5 more an hour And then all of a sudden it's like, great, I just had to spend another year training this person to do an awesome job for me. Why don't I trap them by paying them better than anybody else, giving them benefits better than everybody else, treating them better than everybody else, so that way I can just maintain my staff. So that's also another reason why I like to do it too as well, is because it generates another source of revenue for my call center when they're not taking calls.
Charlie, when someone goes to rent a storage unit, do they typically just want it for a month or two, or are there people that say, hey, I want this for 2 years? Are these all month-to-month contracts?
Yeah, in general, they're month-to-month contracts. So we follow, it depends on the state that you're in, but we do all month-to-month because most of the states that we operate in, even if they prepay, for example, and then they ask for a refund, then we have to give it back to them. And then that's kind of a pain then too as well, because a lot of times they'll ask for a discount, and then it's like, okay, well, now I got to prorate it back because if you didn't have a discount, I lost 2.5% on taking $1,000 payment from you, and then I lost 2.5% on refunding it back to you. So we really discourage prepay anyways. And then also the other thing too about it as well is that because we do a lot of boat RV storage where everybody's moving in October, November, the only reason why we don't like that is because it messes up our books to have a huge influx. It looks a lot better to have it more stable, even growth throughout the year with that. So even if it wasn't the state law, we would always try to go after those month-to-month contracts anyways.
That's a weird law, huh? You got a refund a prepay that you got a discount on.
Yeah, pretty much. I mean, so like, let's say that they got the 12-month free. If we did refund it, then we would have to base the rate on 12 months. And then it's like, so we don't even offer annual pay 12 months or 6 months in advance because we don't want to be putting that, because a lot of times they change their mind. And then we lose money on refunding it back to them anyways.
And Charlie, do you take on investors?
We do, but it's not something that I'm actively engaging. The type of deal size that I'm doing now at this point, I'm not like, leveraging $10, $20 million deals. Most of the deals I'm doing represent only 10% of my real estate portfolio or less. And so in that sense, I would be very selective on taking an investor because I wouldn't want to be in a situation where, like, I got to deal with, and most time it's from friends and family where, hey, this is Jimmy's college fund, don't lose it. I don't want that additional pressure. So I prefer not to use investors' money, but I will do that to offset. So if I was doing a $20 million deal or a $40 million deal and represented a significant portion of my portfolio, I would take investors on, and more likely partners, for the reason of I would want to offset my risk if the deal didn't go as well as planned. The other option I would consider doing would be simply partnering with some of these people I consult on. So if you brought me a deal like in Idaho and I was consulting on the deal and you're like, hey, you know what, I really like having you consult me on this deal, would you consider partnering and help us raise capital? Well, in that scenario, it's like, well, you spent $8,000 for me to look at this deal. I've looked at it side by side with you. Yeah, I do like the numbers. That's why I'm still consulting with you on the deal. In the scenario that I would consider a partner as well. But if I found a deal myself, and we did all three of those things for a secret sauce, we likely would not take on an investor. It would be more like somebody came to us, needing us to leverage one of those three areas I told you about, where, vertically integrating and whatnot. So
got it. Well, Charlie, thank you for the conversation. You're literally the first person that we've interviewed that's really innovating in the self-storage space, and we've interviewed dozens of them. So kudos to what you're doing. How can the best ever listeners reach out to you?
I'm really not on social media much, but if you wanted to get a hold of me and look at what I do more like at a professional level, LinkedIn. So Charlie Gao, Instagram I post, but honestly, at this point in my life, my social that I post is more about my kids and my dog. That's kind of the lifestyle I was going after. But if you wanted to reach out, that would definitely be the easiest way. If you want to discuss consulting or anything else, they can email info at twinoakscap.com. I guarantee they will get great customer service because my staff is incentivized to give them great customer service.
Good. Charlie, thank you.
No, thanks.
Love it. Charlie, thanks for joining us today. Best ever listeners, thanks for joining in today. If you enjoyed this episode, don't forget to leave a 5-star review and share it with somebody who could find it useful. Always follow and subscribe so you can hear us on Wednesdays talking about beyond multifamily, and have a best ever day.